I'll just give you an asset class, and you'll just say up or down by 12 months, right? We're all just guessing here.
Okay.
Your best guess. So stocks, S&P 500, up or down in 12 months.
Unge to down.
Oil,
Uh, Probably down.
okay. DXY,
Down.
uh, we'll do a 2-year price.
Up.
Okay. Do you have a view on the 10-year price?
Should be up as well.
Okay. And your highest conviction play right now that you've got in terms of being long something.
It's 2-year notes for sure. Yeah.
A rough start to the equity markets in October as the Dow falls about 200 points on Monday. Jared Dillian is here to break down exactly what's going on with the markets. We're here to talk about all asset classes, and in particular his macro outlook. Jared, welcome to the show. You are the editor of the Daily Dirtnap, a very comprehensive macro newsletter. I encourage everyone to check it out. We'll talk about your work. Welcome. Thank you for being here.
Yeah. Thanks. Happy to be here.
We'll also be talking about your new book, upcoming book that talks a bit more about the business side of things, not so much markets, but it's also very interesting. So I want to get your take on what you're writing about. Jared, let's talk about what's happening today in the markets. First of all, are you surprised that the government didn't shut down? There was a bill that averted a shutdown. Even Goldman Sachs was projecting, even before last week, they were projecting a high likelihood of a shutdown. Didn't happen. What's your take?
I don't really have an opinion on whether it should or shouldn't have happened, but I was definitely positioned for a shutdown. When I got the email from the Wall Street Journal last night, and I checked my Bloomberg app as to what the markets were doing, I was not happy. We always seem to snatch victory from the jaws of defeat. So
You were positioned in what way? You were expecting a shutdown in markets to be short, or
well, I don't really trade tactically. I'm not really a short term person. I trade over months and years. But I have a large position in 2-year notes. After the news came out that the government wasn't shutting down, twos were down 3 or 4 ticks. For 2 reasons. One, because it's risk on, and two, because really that means that the government is going to keep issuing debt. So it's more supply. So wasn't really what I was hoping for.
well, it certainly wasn't risk on today. Like I said, stocks are down. Is this part of a broader downtrend?
Um, Actually, I'm starting to get a little bit constructive here, and not necessarily because things are getting fundamentally better, but we have payrolls coming up on Friday, and I think the narrative around the labor market has gotten to the point where we keep getting these claims numbers that are around 200,000. The jobs market keeps holding up, and people are like, maybe this is the new normal. Maybe we're never going to get layoffs. And usually when people start thinking that, that's usually the time when things change. So, I'm not really a data scientist. I don't look at the data, but I would say, people are definitely positioned for another strong payroll number. And I think the risk of not getting one is pretty high.
What's your take on yields? The 10-year saw a more than a decade high this summer, and it continues to trail high. What do you think it's going to continue? This higher yield that we're seeing this year?
I mean, it doesn't make a lot of sense. We're looking at real yields of 3% or more at this point, if you think that inflation is 2.6%. So we're looking at very high real yields. And, look, the dynamics of the bond market are such that we have huge amounts of supply. We have huge amounts of issuance. We have China ostensibly selling and possibly other foreign governments. Just the psychology of the bond market, like back a couple of years ago when tens were at 1%, everybody wanted bonds. And now that bonds are at 5%, nobody wants bonds. I mean, it's classic market behavior, so I think we're kind of in this, negative feedback loop.
Do you see this trend in yields as a risk on kind of mentality from the markets, in the sense that bonds are selling off in anticipation of either an improving economy or an improving stock market? Is that what's happening?
No, I really don't. I mean, I think it's more a function of supply. I think it's a function of issuance, and I think it's a function of foreign government selling. I think it's really, I mean, if you think about interest rates, a lot of people have different models for interest rates. They say, well, it's because of money velocity or productivity. And, people have all these models as to like how to model interest rates. But really, ultimately, it's supply and demand of government bonds. And right now, we just have a lot of supply, and not a lot of demand.
You did comment on the dollar versus interest rates. The DXY saw a tremendous uptick over the course of the summer up to now. You wrote in one of your recent newsletters, I'm having a tough time figuring out whether the dollar is leading rates or rates are leading the dollar. I think rates are leading the dollar. It's a question on a lot of people's minds, Jared, which is coming first. Certainly there's a correlation. What's going on, you think?
Well, a lot of currency movements are based on interest rate differentials. So if rates go up in the US, it makes the dollar more attractive. So I do think that rates are leading this dynamic. The dollar is up again today a lot. The dollar has been up 13 weeks in a row, which is insanity. It's pretty rare that anything is up 13 weeks in a row. So like I said, going into payrolls this Friday, I think the market is very one-sided. I think it's one way. I think people are positioned for another strong payroll number. And if it's at all weak, we could have a big reversal. It could be a very powerful reversal. So
are you okay? So could we extend this and say if we get a recession by either next year or maybe even later this year, if it happens, I'm not saying it will, but let's say we do get some sort of hard landing, is that going to wipe out the gains in the dollar?
It should. It should. Absolutely. And it should, look, like I think 10-year yields belong somewhere between 2.5% and 3%. And I don't think that's an out of consensus opinion. If you look at the dot plot of the Fed, if you look at the 2024 dots and the 2025 dots, the Fed sees rates coming down. Like I think everybody thinks that.
What do you think the Fed is going to do then? Are they going to continue with their tightening program? Are they going to find some wiggle room to pivot at some point?
Well, Williams said that he kind of intimated that he thought that we've had our last hike, and I think we've had our last hike. The last I saw, I think last week, we had a 40% chance of a 20 basis point rate hike in November, and I don't think it's going to happen. I think we've had our last hike, and historically, in a rate hiking cycle, the Fed has difficulty maintaining rates high over a long period of time. Like the longest the Fed is able to maintain rates at the peak has been 7 months. So, that puts you at cuts in about March. Right now, the Fed funds futures are pricing in the first cut in August. So I think it happens a little bit before that.
Well, let's talk about TLT. You wrote about TLT in a recent newsletter as well. Buying the dip on the TLT, is that something we should be doing?
Well, I don't have. See, this is how we got into this mess. Like, I don't really have a super strong opinion on the long end of the yield curve, because it's driven by factors that you can't really control. Like my position is in the front end in 2-year notes, and the one thing that's been happening over the last few weeks is that the back end has been selling off viciously and the front end has been, pretty stable, and the curve is steepened a lot and it continues to steepen. So, look, like 10s, 30s, 20s could, yields could go up more, in between now and the first rate cut. So for sure that could happen.
First of all, isn't the 2-year yield very much correlated with what the Fed's doing, or expectations
absolutely.
of what the Fed's doing? Yeah.
Yeah.
So you're essentially trading Fed policy when you're doing that.
Yeah, absolutely. Yeah. Yeah.
The 10-year minus the 2-year yield has been re-inverting back to zero. It's been negative, but it's been steepening. Is that an indication of a recession to come? If you look at the yield curve throughout history, usually it inverts and then it re-inverts back to zero before you get the NBER designated recessions. Is that what's happening right now?
100%. So, when the yield curve first inverts, it gives you the first indication that a recession is coming. A recession can happen anywhere between 3 weeks and 18 months after the first yield curve inversion. We're at about 15 months right now. So, yeah, like when the curve starts steepening again, that's usually when the recession actually happens. So I think that's very possible.
I haven't been able to pin down exactly a consensus on what needs to happen for a recession to officially be recognized. What is your take? What is your definition of when this, what a recession should be, or signs that you would look for to officially recognize that we're in a recession?
Well, the way I was taught was two consecutive quarters of negative growth, but the definition of that seems to be shifting over time, like it seems to be kind of fuzzy right now. It's like it's a recession when they say it's a recession, but I still think it's 2 quarters of negative GDP growth.
If you look at the NBER website, it's funny you bring that up. They have an FAQ section, and one of the FAQs is, why don't you look at 2 quarters of negative GDP growth as one of your criteria? And their answer is we don't, because we have 7 other criteria that we prefer to look at in terms of economic indicators. So you're right, they don't look at that. They actually, I don't think they really have in the past. I don't know if they should rewrite our textbooks. But all right, so 2 quarters of GDP aside, what other indicators are you looking at that could suggest that we're in a slowdown?
Well, I mean, the real question is what's the labor market going to do? Because historically, when you have a slowdown, you get job losses. And, the question is can we have a recession without job losses since the labor market has been so strong? I don't know the answer to that question. I think we will get job losses eventually. I mean, what we're seeing is we're still seeing distortions from the pandemic, from all the stimulus money that was injected into the economy. It's one of the reasons the labor market has been so strong and we have a shortage of workers. But that's temporary. Like that'll go away. So,
Well, sorry, what exactly is temporary?
well, anytime you have a shortage of labor, I mean that's a temporary condition. That's not going to last forever. Nothing lasts forever. So.
Okay, so generally speaking, let's talk about your portfolio then, or how you're looking at the markets. Are you
Yep.
generally then positioned for an economic downturn? Is that a fair way to sum up your positioning?
Yeah, that's fair. That's fair. Yep. Yep.
Are you hedged to the upside at all?
What do you mean by hedge to the upside?
Let's say we have a boom. Do you have positions that'll benefit from let's say an economic boom or a
No,
stock market
absolutely
boom?
none. Absolutely none. No.
None. Okay. Is that because of your strategy, or do you have an algorithm, or your conviction on the
An
economy?
algorithm.
I don't know. Some people stick with a very strict trading algorithm. So well maybe that's you, but
No, I mean, look, like I'll try to sum this up. So I think that we have been in a bear market for either 21 months or 33 months, depending on how you look at it. The top of the bear market, the top of the bull market was in January of 22. It was January 3rd of 2022. That was the high print in the stock market. We have been below the high watermark for 21 months. At one point, the market was down 25% in 2022 in October, right? So this has been in terms of length, this has been a pretty long bear market. If you look at the financial crisis, stocks peaked in the summer of 2007, and they bottomed in March of 2009, which was about 21 months. Like it really wasn't that long in terms of duration. The bear market from 2000 to 2002 was pretty long. So you can't just look at things in terms of price. You have to look at things in terms of time. It was funny. I was flying back from Connecticut last night, and I was sitting next to a guy who was like an IT guy at a community college. He was in his 50s, and he said he had one mutual fund, and he was underwater on it, and he was waiting for it to get back to Unch, and then he was going to put everything in T-bills. That was his plan. And it's funny because I think there's a lot of people like that. I think there's a lot of people who are below their high water mark and they're waiting to get back to their high water mark. So there's still a lot of pressure on the stock market, you know.
there's pressure on the stock market from which sectors do you think are likely to suffer next the most?
Well, I would not have predicted what's happening to utilities, what's happening today. That's pretty crazy. Utilities are down 5%. That's nuts. Um, I tend to think, look, like, I sort of have a value bent. I do better as an investor when value stocks do better. I did well in 2022, picking mostly value stocks. That was like one year where value outperformed. What I would like to say is that, the seven big tech names, Tesla, Google, Microsoft, Apple, et cetera, like I think they should underperform and the other 493 stocks should outperform. And in terms of the index, that doesn't necessarily mean the index goes up, but it means you get a broader rally in the stock market. That's what you should see if we're going into a recovery. So,
Do you see any scenario in which I'd say the 2 year rises in conjunction with stocks into next year?
to your yield or to your
Yeah,
price,
yield.
that would be a nightmare scenario for me for sure. But I mean, look, I don't think so because the Fed has pretty much telegraphed their intentions that they are done hiking rates. So it would take a huge reacceleration of growth and a reacceleration of inflation for the Fed to reconsider that.
We haven't talked about inflation. You did write in one of your newsletters. You commented on the oil price. Certainly, oil was a big factor in the higher CPI over the last 2 months. What's your technical read on the oil price right now?
It's funny. It's getting a little bit crowded. Not egregiously crowded, but I think more people are piling into energy. It's one of the few things that's held up. I think it's one of the few things that's working. It's starting to attract sponsorship, and it makes me less bullish on it. I wouldn't say I'm necessarily bearish. I wouldn't short oil here, but it's definitely getting less attractive.
All right. Before we close off on markets and talk about your book, let's just do a 1 minute lightning round. So let's just sum up your thesis for the audience. I'll just give you an asset class, and you'll just say up or down by 12 months, right? We're all just guessing here.
Okay.
Your best guess. So stocks, S&P 500, up or down in 12 months.
Unge to down.
Oil,
Uh, Probably down.
okay. DXY,
Down.
uh, we'll do a 2 year price.
Up.
Okay. Do you have a view on the 10 year price?
Should be up as well.
Okay. And your highest conviction play right now that you've got in terms of being long something.
It's 2 year notes for sure. Yeah.
Excellent. All right. Good summary, Jared. You have an interesting book title, How to Live a Stress-Free Financial Life. It's kind of ironic you would write that book and also be in the fund kind of management business because it is a very stressful profession for a lot of people. Before we talk about that book, how do you balance your life? How do you eliminate, or not eliminate, but control or manage your stress, given that you're in this industry?
Well, it's funny. So the book is called No Worries: How to Live a Stress-Free Financial Life. It comes out in January of 2024. It's I have a great job, writing a financial newsletter. It's a great lifestyle. It keeps me connected to the markets. It keeps me connected to people. I like to write. I can travel. I can do all sorts of things. It's a great job. One of the things I hate about it is that, I sit here in this office and I am watching screens all day long. And I'm watching things tick. I'm watching things go up and down. And these tiny movements in stocks and gold and everything else causes me stress. And what I would like to do someday is to stop doing this job so I can stop. And literally, so one of the things I talk about in the book is my solution for managing your assets in a stress-free way is something called the awesome portfolio, where you have 20% stocks, 20% bonds, 20% cash, 20% gold, and 20% real estate. And this combination acts in such a way. Let me just tell you some of the statistics on this. This portfolio, this 20% portfolio, has returned 8.4% over the last 50 years. And the biggest drawdown has been 10.5% in a year. And you have half the volatility of an 80-20 portfolio. So really what I like to do is just put my money into the awesome portfolio, which minimizes your volatility. It gives you the best ratio of risk to return, and just forget about it. And that's what I'm encouraging people to do in the book. I mean, there's a lot more in the book. I'm talking about credit cards and mortgages and stuff like that. But when it comes to managing your own money, see, a lot of people say you should be in index funds. You should have all your money in the S&P 500 index fund and take a giant 57% drawdown during the financial crisis and take a giant 50% drawdown during the dot-com bubble. And, you take these massive drawdowns and it increases your stress. So I like structuring my financial affairs in such a way that it minimizes my stress.
All right. Can you give us some strategies of how to minimize stress?
Well, it's really about building a portfolio where each member of the portfolio, its contribution to portfolio risk brings the risk of the portfolio down. Gold is a perfect example. I'm not a gold bug. I'm not a tinfoil hat guy. But the great thing about gold is that it minimizes portfolio risk. You can add it to just about any portfolio and it improves the risk characteristics of that portfolio. And this is why a lot of people say, look, if you buy an S&P 500 index fund, you're diversified. You own 500 stocks. But the problem is that 50 million other people have the exact same position. So you're not diversified. You have to be diversified across asset classes.
Why not just own cash then? I mean, in today's interest rate environment, you could collect 4.5% on CDs.
It's funny because when I first developed the awesome portfolio, it was like 2018 or 2019, and cash is part of the portfolio. And everyone said, why are you including cash? Cash doesn't yield anything. I said, well, just wait. It might someday, but the thing about cash is that it also immunizes volatility.
Okay, so I guess it depends on who you are as an investor and what life cycle you are in your career. For you right now, do you want volatility?
I really don't. I don't. But nobody does. See, like the purpose of volatility.
Traders do. I asked this question to traders, and they're all like, "Okay, I hate calm markets. I want volatility."
I'm a long-term investor. I'm not really a
Right.
trader, so yeah.
I understand. Okay, so what can we learn from your book in terms of living a stress-free financial life?
Well, there's really three parts to the book. And the first part of the book is your attitudes towards money. Okay. And just for example, the first chapter of the book is about wanting money. Like a lot of people think they want money, but do they really want money and the things they have to do to get money? And I talk about this concept called the revenue side, how most personal finance literature focuses on cutting expenses, not drinking coffee and buying cheap toilet paper and stuff like that. Where what I say is that cutting expenses really doesn't move the needle very much. What you should do is focus on earning more, making more revenue. So that's the first part of the book, is about attitude. And the second part of the book is about debt. And the two sources of financial stress are debt and risk. So I go into all the different types of debt. I go into credit card debt and mortgages and student loans and car loans and stuff like that. And the third part of the book is risk, where I'm talking about investing. And I have a great discussion on risk, I think, in chapter 12. Then I have a chapter about investment basics, just learning about the markets. And then I talk about the awesome portfolio. So it's all about minimizing your financial stress.
I just like to state for the record that I think coffee is probably the best expense that anyone could spend money on, because without coffee, I don't have the energy to make money and generate revenue. But anyway, that aside, I look forward to reading your book. Where can we learn about the awesome portfolio and your other work, Jared?
Well, the awesome portfolio, you can actually purchase a primer, I guess, on the JaredDillianMoney.com website if you want to learn about the awesome portfolio. You can also, I'm at Jared Dillian Money. And if you want to subscribe to the newsletter, it's at DailyDirtnap.com.
How often do you rebalance this awesome portfolio?
Once a year.
Okay. All right. Well, thanks very much. Great introduction. I look forward to speaking with you again on more market news. Thanks for being on the show.
Great. Thank you.
And thank you for watching. Don't forget to follow Jared and like and subscribe this video.